Hi guys, I'm happy to present you my new MDM model portfolio. The reason why I came up with this is because I had another very big loss past year. I lost 80% of my portfolio from the high I had achieved, and this has happened before with me. It happened also in 2018. I lost 80%, and that's really very painful, and it makes me really reevaluate my strategy and improve it. mm, and this is what I came up with. So my portfolio, well, the reason why I made lots of losses the past year is because, well, crypto went down a lot, and especially my favorite coin, Bitcoin Cash, it went up to $1,500 and it dropped to $300. My biggest position, so that's of course a big loss. And then also in my stock portfolio, my old tankers didn't do much. My airlines had gone up a lot, but then they were also cut by half again the past year. Um, and then I had also a bunch of shorts on gold that well didn't do it. It didn't do much. It went down first, but now it went back up at the start of the war. Now commodities was up again, so I didn't make any money there, but I also, so that was okay, but I didn't lose money also, but I did lose lots of money also on the options. I had a whole lot of put options on GLD on gold, and they just expired worthless. And I did that for a good half year, and yeah, I lost also 20% of my portfolio on that one, or 10%. So made quite some mistakes, but also really made the mistake not to lock in any profits when I was so high a year ago. I didn't lock in profits, and not in crypto because I thought it would go higher, and not in stocks in airlines because I thought it would go higher, and yeah, that's also not good. Um, and some of the things that I did see, um, I didn't take in. For example, I also made videos at the time that I think bonds interest rates will go up, so shorting bonds is a good trade, and I would have made money on that, but I didn't take in the position. So, or only with 1 or 2, 3%, that doesn't count. Huh? So, in order to avoid such mistakes, um, I'm changing my strategy. So before I had a strategy like, if you're in a bull market, you just buy and you hold the whole way through, huh? And that's 10, 20 years. Of course, you can flip for other similar assets, but you're not selling for cash. Huh? Um, but well, I should have done. I should have sold a piece for cash, huh? Even when the bull market's not finished, if things have just gone up a lot. I mean, nothing goes up in a straight line, even not in a bull market. There are always corrections. And if you are smart to cash out some to cash, then, well, it's going to reduce the volatility of your portfolio a lot. Okay, the total returns won't be higher, probably, uh, but the volatility, but the total returns will also not be lower. They will be the same, but your volatility will go down a lot. So that's why I've decided, like, everything that I'm bullish on, I'm taking a position on, which is now for cryptocurrencies and stocks. Like, I am going to also sell half of that position if it is overbought in the short term. Huh? um, and I also like leverage, but I've made mistakes there also. Like, leverage is something new for me. Borrowing money against your crypto, or using the leverage instruments from your stockbroker. Uh, uh, I like that. I think that's smart, but it's a very dangerous tool also, and I've learned it very quickly here. Um, uh, the equity in my stockbroker's account. Well, I got margin called on my loan. Well, I had borrowed against DPI crypto, and it was recently a crash, and yeah, my liquidation price was too close to the market price, and well, I got liquidated. Eh. It's not fun. It's not good. Uh, um, but okay, I mean, I could have really avoided that by just not, yeah, having by not being so close to the market price, my liquidation price. But also in my brokerage account, made the big mistake of, in the past I didn't use leverage, never did. But when I started losing leverage, when I started shorting, because what I did was, okay, I have a long position in stocks as usual, but then I also short commodities, gold here, and I get cash from that, and that cash I also invest in stocks. But then you're actually starting to create leverage, huh? Because you're borrowing now stocks, huh? And then you're also using that cash to invest in something else, and now you're really levering up, and so you end up being like levered up 3x in my case often. And so compared to the capital you have in your account, let's say you have like, I don't know, 1 million in your account, you're actually having for 3 million exposure, huh? And so if your exposures go wrong, which was in my case, my stocks go down in value, and my short starts to go down in value. Oh, suddenly, like, my capital is shrinking very quickly because I have three times more positions taken in than the capital I have in the account. So it went a little bit out of hand. I didn't keep a good eye on how much leverage I'm taking. I was maxing it out basically, which is really not smart to do. So beginners mistakes I've made when it comes to leverage, because, well, I have no experience with it also. So but now I do have some experience with it, and I implemented that in this plan. So first of all, the plan starts with, like, okay, how much I want to be allocated. Eh? So this is for me a bull market in cryptocurrencies, a bull market in stocks, long term. So long term, we're in a bull here and a bull here. Commodities were in a bear, and bonds were in a bear. You look at my other videos, why I believe that strongly to be the case. These are the videos about historical returns I make often, and there I show that. Well, the long-term cycles of stocks over the past 100 years, we're clearly still in an up market here for the blue line. And for the next 10, 20 years, we're likely going to have high returns for stocks. Gold is inversely correlated clearly to stocks, and we're clearly in a bear market, likely going to also continue to be in a bear market for the next 10, 20 years. And gold is correlated to commodities, is the same cycle. All commodities and gold are very correlated. And then interest rates as bonds, they also are in a, well, bottoming out here. Interest rates, and likely will interest rates go up for now 50 years. They went down for 50 years. They're likely going to go up now for 50 years, and before that they went also up for 50 years. And so we're likely starting a very long period of rising interest rates, very slowly rising interest rates. And that means being short will make you money. And of course, cryptocurrencies went through that also a lot. The Trololo chart clearly shows that. Let me show that Trololo chart. Yeah, I'm not updating my sheet anymore, but there's this sheet here from Asoft, and there you can find it up to date till now. Huh? And so, yeah, there's clearly a bull market, bear, bull, bear, bull, bear, bull, and the bull has not really completed, so we're still in a bull market. Um, Very likely. Huh? So that's why I have uh, these opinions that we're in a bull market for crypto, a bull for stocks, a bear for commodities, and a bear for bonds. So what does that mean? How much do I want to allocate? Usually, what do? You 100% stocks or you do 100% cryptos when you believe in a bull market, or you split it between, you have some stocks, let's say 20-30%, and then you have like 70% cryptos. But I do want to also short the bear markets because, well, it's an opportunity. And actually, these are also the ones that will go into a bull market when the other ones go in a bear market and these ones go in a bull market. So I do think it is wise to short, but of course, like shorting is a very dangerous instrument. Huh? Shorting can lose you more than you have. It's a very, very tricky instrument. You're borrowing also. The moment you start borrowing, there is lots of more risks involved. Huh? You cannot short without borrowing. You always borrow something that you short and then you sell it in the market, then you have to buy back later. And well, it might become very difficult to buy it back later when it goes up and up and up. So that position needs to be small per definition, and needs to stay small if it goes the wrong side. Um, and uh, so that's why I choose 10% for commodities and also 10% for bonds. Of course, this all need to be verified with the Kelly criterion, because that's where you really calculate how much you can allocate. Uh, uh, but usually, this checks out. Of course, it's lots of work to always calculate Kelly criterion. It's also a bit a lazy approach to investing. Um, um, but yeah, I chose for the you know cryptocurrencies for still a large exposure of 50%, stocks 30%, that's 80, and then 10 each. But that's in the case of when everything is normal. Of course, rarely the case. Usually, it could be either oversold in the short term, that's long term, but in the short term, it can be oversold or overbought. While cryptos are oversold in the short term, same for stocks. And so that means I want to do a little bit of leverage. That means like not 100% leverage, but 50%. That's what I think is fair. Some leverage. That means like you have like you borrow 50% is your own capital, and then you borrow an additional 25%, and the total an additional 50% of your position you borrow, and then you invest that also. It's not low leverage, I would say, but if it's applied correctly, then it is not that risky. And applied correctly means you don't keep the leverage. That's also a mistake I've made in the past. I had the idea like you borrow and then you just do the whole bull market with that borrowed money, and you only sell and close down the loan when you reach the peak of the bull markets. But that strategy is too dangerous because inevitably you will have corrections on the way up, and then suddenly, like what was a small amount becomes a much larger amount to pay off, and it becomes much harder to invest well, and that's what I have also experienced now. Like I know that with these corrections I should be a buyer of stocks and not buyer of stocks, and I should certainly not reduce. I should not, and I should be a net seller of commodities, but I couldn't because I was over leveraged. So I had to reduce leverage, meaning I was also a seller of stocks, meaning I was also a buyer of commodities, and that's very bad. That means you're locking in losses, which I have had to do. In order to avoid that, you need to actually, yeah, you can during the hard time lever up a bit, but you also need to get rid of that leverage as soon as markets basically rebound, and you made money with that. You need to also cut that back and pay that down, so that you have no leverage left. So that's my plan here. Yeah, I have some leverage now with crypto, but the moment the bull market is back on track and we have average valuations again, in the short term, then I need to like reduce leverage. And if we go to overbought in the short term, even we're not at the end of the bull market, then I need to also sell half, and that means that I need to I get cash, dirty fiat, in exchange for my valuable crypto coins. Huh? That just went up a lot. These are the difficult decisions to take. Huh? Just like it's very difficult today to lever up, huh? When there's lots of fear in the market, it's very difficult. But if you have a disciplined approach, I believe, and a clear plan and strategy, I believe this will pay off, and it makes sense. But it's very difficult to do these things. That's why you need a solid plan. Um, so yeah, same apply to stocks here, and then commodities. Okay, same here. Some leverage, but since you're starting with a small position, you lever up with 50%. Still a small position. You go from 10 to 15%. Um, and yeah, you also close this position. You scale it back to the moment commodities. Today, um, commodities are in a bear market, but it just went up. It's overbought in the short term because, well, we had the Corona crash, the Corona crisis, which caused commodities to go up. First, they crashed to zero, but then they went up a lot because the economy got restarted, and there was very high demand for commodities again. But since they has just shut down so much and there's so much red tape everywhere, and also a shortage of labor, commodity prices went up due to a shortage, but it's a short-term shortage, and then suddenly we have this war, of course, causing a lot more shortage, or at least fear that will be shortage of commodities, pushing up prices even more. So it's overbought in the short term now. So some leverage is justified, I think. But the moment that these fears of war would go down again, then probably commodity price will also go down, or yeah, and then it's back. It's time to also get rid of the leverage. And bonds, I think, is the only thing that's averagely valued. I can show that. So we have the bonds here. These are the past since 2004 or so. Yeah, 2002. The iShares 20 plus years iShares Treasury Bond ETF. So the value went up from 88 to 160 times 2 in 20 years, and then it dropped. Um, so during the Corona crisis, and here you see also the interest rates, and there's points here, but it starts here in 2011 at 3.4% interest, 10-year note, and then it starts dropping from 3% to, oh no, 3.5 to 3, and then during the Corona crash, it goes finally to a 0.5% only for 10-year Treasury bonds. And the moment it drops here to 0.5%, of course, then the value of long-term bonds goes up a lot. And then since the Corona crash year, it was a 0.5%. It went back up to 1.5%, and then it went back up to 2%. And now recently, only the past 2 weeks, it has dropped to 1.7%, due to the war, or the fear for war, or the start of a war. So when is the right time to start shorting bonds? Ideally, of course, here during the Corona crash, when interest rates dropped to 0.5%, and everybody was saying, "Oh my God, I'm going to go to zero and below zero, and it will stay low forever." Well, that was not the right call because it went up. There was a good time to short bonds. I made the call, but I didn't take the position, or only a little. Um, that was the best time. Since then, it really interest rate went up a lot. You made a lot shorting because you short your iShares 20 plus Treasury bond ETF. The value was 170 and it drops to 140. Huh? it goes back to 150. We're back at 140 now. So if you can short something that's worth 170, and then you sell it in the market, and then you can buy it back, give it back late. You have to buy it back at 140 only, and that's only over. Yeah, then you made a very good trade. So but I think like right now interest rates have gone up a lot again from 0.5% to 2%, but they're starting to drop now again. So I think it's a good time for me to start taking in that position, and nibble at it and build up a 10% exposure to shorting bonds. And that's for the long term because we're talking about a 50-year cycle. But of course, you do play the long term now, by either like, also with the bonds here. So yeah, I'm gonna go for a 10%, maybe even uh, yeah. But the moment that it would rebound and interest rates shoot up, let's say to 3% or 4%, then of course it will be probably um, overvalued in the moment, and then I have to buy back half of the position, and pay it back, because I just made good money on it. So yeah, that's the plan. And then for the future, um, of course, this will all change. But when? Well, cryptocurrencies can change quite quickly. In 1 year, we may reach the peak of the bull market, and then we go into a bear market, and then of course that's a different story here. But how much exposure do you want to have then? Needs to be verified with Kelly criterion. But I would think like, um, maybe a little bit higher than what you have where I chose with commodities or bonds, because cryptocurrencies drop a lot more than commodities drop or bonds drop. Cryptocurrency can drop easily about 90% in a bear market. That's not the case with commodities. Yeah, commodities will do that also, but it takes them 20 years. But for cryptocurrencies, yeah, only take 2 years to do that. Um, and And with commodities, you have to, yeah, it's after inflation. With cryptocurrencies, it's before inflation. Um, and after inflation doesn't count. But so stocks, if it's a bear market, maybe also on a low exposure, 10%. But where would I be then if it's a bull market? Well, commodities, I mean, that's a great bull market if you can catch it. That has high returns. So that would be worth 50%. And bonds, if they are in a bull market, can make money also, but not nearly as much as you can make in stocks or commodities or crypto. So even if it's in a bull market, it doesn't deserve that high of an exposure. Um, okay, this is all for the future. It's not the case right now. I hope you enjoyed it, and thank you so much for watching.